Kia ora and welcome to the 2023 Monetary Policy Challenge webinar. I'm Georgina Hassel. I work in the External Communications team here at Te Pūtea Mātua and will be facilitating today's webinar. I'm joined by Paul Conway, Marie Singh and Andre Castaigne. The panel today is going to talk to you about our May Monetary Policy Statement, a bit about their jobs and what it's like working in economics at the Reserve Bank of New Zealand. At the end of the webinar, we'll be announcing the question, we'll be inviting students to answer in a short video, but more on that soon. If you do have any questions for our panel throughout, be that about the May MPS, monetary policy, or what it's like working at a central bank, please add them to the chat box below and we'll do our best to answer them. Without further ado, that's enough from me. Let's pass over to our panel to introduce themselves.
Nice, George, thank you. Kia ora, koutou katoa, ko Paul Conway, toku ingoa. I'm Chief Economist here at Te Pūtea Mātua, the Reserve Bank of New Zealand. I've been in the job for about a year. Now, I came from, I was Chief Economist at the Bank of New Zealand for a little bit, and prior to that I worked at the New Zealand Productivity Commission, and I've also worked internationally at the OECD based in Paris, the Organisation for Economic Cooperation and Development. Now, I grew up in Invercargill, down in the deep south there. Central Otago was the backyard, and I studied at the University of Otago and the University of Victoria. Just sort of bouncing off what George was saying, it's a pretty exciting time to be working at a central bank. Obviously, inflation is far too high, as we'll see in our presentation, so we've got a huge focus on getting that back into our target band, so lots of ideas bouncing around the place. It's a really dynamic place. I feel really privileged to be in this role at the moment. I think it's a place where we really can deliver good impact. And part of the reason I'm excited about this monetary policy challenge is because it's about the pipeline of future economists coming to places like the Reserve Bank of New Zealand or the Treasury or the public sector or the private sector. And New Zealand is a tricky little economy, so the more sort of brains we can have thinking about it, the more likely we will be in terms of improving New Zealand's economic performance and lifting the well-being and prosperity of our country. Thanks. Marie, over to you.
Hi, kia ora. I'm Marie Singh. I'm an economic advisor in Central Banking Analytics in the economics team. And a little bit of a journey. I've been at the Reserve Bank for about 3 years, but it's been a journey to get here, I think. I'm actually from South Africa. I was born in a little town called, well, I suppose it's not little, a city called Gqeberha, or formerly known as Port Elizabeth. And like most people, I had no idea what I wanted to do in high school. And so I thought about what am I good at and what pays money. And so I thought, I was like, well, I'm mathematically inclined. I'm going to be an actuary, right? But I was a bit young, so I couldn't go to university. My parents didn't want to let me go to university outside of my hometown of Gqeberha. And so I decided I would enroll in economics and statistics degree at Nelson Mandela University, and then after a few years I transferred to the actuarial science degree. And then I had the greatest privilege of my life of being a Mandela Rhodes Scholar for my honours year in mathematical statistics. And it was there that it changed my life. I thought, what do I actually want from my career? One, I want a career where I'm constantly learning and growing, which is frustrating, but also the future I've chosen for myself, so I also enjoy it. And two, I want a career where I feel like I'm making a difference, that I have a purposeful life and a purposeful career. And that led me actually to the South African Reserve Bank in the grad program, where I became a central banker. I was in forecasting. I went on to do a master's in economics in Oxford. A few years later, I started missing data and stats, so I did a master's in data science. And through that entire journey, I've now ended up in central banking analytics at the RBNZ. And what does my day look like? It depends on the day, it depends on the time, but it's really exciting. I get to look at macro models because I still love modeling and statistics. I get to look at new data and techniques that we're using to understand and monitor the economy. I get to look at things I care about like financial inclusion or go to seminars and friends' work on climate change. It's varied and interesting and exciting and fun, and I'm very happy that in the end I ended up being a central banker.
Once you got into the economics, you couldn't. Yeah. There was no going back.
I couldn't go back. Yeah.
Andre.
G'day, I'm Andre. I've been at the Reserve Bank about 2 years now. I've done some time in the economics department here and some time in the financial markets department. Prior to coming to the Reserve Bank, I studied at Otago University and I mainly studied finance. Did finance and computer modelling during my time there. Prior to starting at the central bank, I didn't know that I wanted to be a central banker, much like Marie, and honestly didn't know a lot of sort of what it was all about, and had a fairly limited economics background. But during my time here, I've learned a lot about what's in the economy, how does it affect people's lives, how do we make good positive change so that people have stable jobs and incomes and are able to buy the things that they need to buy. Hometown from Nelson, Kiwi born and bred, yeah.
Nice.
Oh, nice.
So kind of thing I took out of both of you guys talking is about making a positive difference. I think that's a really, you know, when I think about an economist, they have to be sort of curious about how the world works, and also they have to, you know, kind of care. They have to give a toss. Like they've got to be into making a positive difference. New Zealanders, we've been told no swearing on that.
Oh, great. Well, thanks for introducing yourself, guys. I think it'd probably be best for us to move into a bit of an overcap of our latest monetary policy statement, the May MPS.
Sure.
So yeah, we're going to run through a presentation of this, I think. So we put this out a couple of weeks ago today.
2 weeks to be exact.
Yeah, 2 weeks, a couple of weeks, 2 weeks ago today. It is Wednesday, I think.
Yep.
And we sort of, I don't know, we surprised people a little bit. We increased the official cash rate by 25 basis points, and we had it peaking at 5.5%. So there's a lot of economics in behind that decision, which we're going to just sort of rattle through now.
So, as Paul talked to a bit earlier, inflation's still far too high in the New Zealand economy. The current inflation rate is well above our target band and has been for a while now, as you can sort of see on this chart. That's a problem for us. That is something that we're looking to fix through having contractionary monetary policy to return inflation to that 1% and 3% target band where we're comfortable in it.
And this CPI, can you tell us about that and how and why you measure it from that?
Yeah, certainly. So CPI is the Consumer's Price Index. Its job is to try and capture an average basket of goods that an ordinary sort of person in New Zealand has. Everyone's different, everyone consumes different goods in the economy and different services and in different ratios and all that sort of stuff, but it tries to capture in aggregate what are consumers spending their money on, and in particular, how much are those prices going up. And so we're trying to make sure that on average, prices don't go up too quickly. So we're not looking specifically at, say, food or at petrol, but all of those things are part of the CPI as a whole.
And our remit is to ensure that the change in CPI is between 1% and 3%. So obviously you can see from there it peaked at 7.3, I think, and it's dropped to 6.7 in the March quarter of this year, you know, which was great, but still obviously, as Andre said, far too high, and we've got plenty of work in front of us to get it back into that shaded area there, which is our target range.
We also have had inflation expectations being well outside the target band recently across a range of horizons. Marie, why do inflation expectations matter?
So they matter for quite a few reasons, thanks Andre. And I'm sure Paul will follow up on it too. But it's about understanding how people are not only experiencing inflation, but what they expect inflation to be, because this influences all kinds of conversations. What conversations you have with your employers about your wages, how businesses plan for the future, as well in setting those prices, because they have to try and plan for what's happening in the future, you know. And so all these things kind of fall into how inflation evolves in the economy. And so it's something we keep a very tight watch on, because we're worried about, you know, is this inflation now going to be more persistent? Is it going to become embedded? And when we say the word embedded, that's what we mean. Are people expecting inflation to stay high? because that's going to make inflation stay high in some regard. And so that's why we care about it very much. And those longer term ones that we see on the screen there in purple and green, those are the ones that tell us, are we doing a good job as a central bank? Do people trust us that we're going to bring inflation back? And so while we do monitor those 1 and 2 year inflation expectations because we're worried about inflation over the medium term, we also look at those other 2 rates because we worry that people trust us to do our jobs, and we're making sure that we're delivering to the public on what we say we will. Yeah.
So yeah, we'll follow it up. Why not? So yeah, inflation expectations are really critical because, for all the reasons Marie talked about, if people expect inflation to be whatever X% for the next 2 or 3 years, then it's more likely that it actually will be X% for the next few years. So inflation expectations can become self-fulfilling in a way. And there's a heap of economics in behind that. In fact, so much that I made a speech on inflation, essentially on inflation expectations a few months ago. So if you want to sort of get into the economics of this applied to the New Zealand context, then look that up. It's called The Path Back to Low Inflation in New Zealand. So the good news the positive dynamic out of this graph is that inflation expectations in the most recent quarter have fallen a bit, just consistent with our kind of central message that, with higher interest rates, we are managing to cool the economy down to sort of take that extra heat out of the place, which is what we need to get inflation back down in its box. So this is, an important part of that picture.
Mm-hmm.
We also have another part of our remit. We have 2 objectives that we try and balance. The second one of those is to support maximum sustainable employment. Maximum sustainable employment isn't something that's directly observable. It comes across a number of indicators, one of which is the unemployment rate that you can see on this chart. But it also includes stuff like wages, hours worked, people in employment. There's a table in the monetary policy statement that sort of talks you through different indicators and where they are. Currently, we think that the economy is running too hot, including in the labour market, where businesses are struggling to be able to find staff, and there's a bit of a matching inefficiency there. As part of us lifting the official cash rate to return inflation to 1 to 3%, we hope to be able to normalise some of those imbalances within the labour market to return unemployment and employment to a more sustainable level. And that will mean that, as you see on this chart, that unemployment is likely to rise over the next couple of years. However, that is, as you can sort of see at the end there, some of that may be temporary, but it is part of us. There's a trade-off in our remit between the labour market and inflation.
I should say, it'd be great if we could run the labour market at, 3.4%?
Yeah.
Unemployment, because that's super low, as you can see from the chart there. It's much lower than what we've had in the past. But there's a whole bunch of more structural labour market settings that determine where that sort of equilibrium level of employment and unemployment is in the labour market. For example, if our skills system was pumping people out with exactly the right skills that were in demand in the labour market, or if people lived exactly where the jobs were across the country, then that sort of equilibrium rate of unemployment and would be lower, and employment would be higher. But we don't have any control over that, so it is likely that as we continue to work to bring inflation down, that we will see an uptick in unemployment as part of that process.
So currently in the economy, we're starting to see demand slow. So this is one area of demand that you can see here, which is for durable goods. We've been seeing a lot of excess demand in different parts of the economy. There's been in goods. When we had the pandemic, there was a whole load of supply chains got messed up around the world. People couldn't buy things you saw in the supermarkets over summer due to dysfunction in the eggs market. You couldn't buy eggs for love nor money.
I remember that.
and
Or you had to sell a kidney.
Yeah, exactly. Exactly.
Or know a guy, yeah.
And when we had the lockdowns,
Don't swap
people
your
went
kidneys
out
for eggs.
People people went out and sort of wanted to buy an Xbox or a sofa
Yeah.
or stuff
'Cause
like
you're
that.
stuck at home.
Exactly. And so
Yeah.
you had these big shortages.
Is that what durable goods are? They're like physical things, not like food, for example.
Not eggs.
Yeah, they're physical things, your sofas and your bed.
Xboxes. Yeah.
Fridge.
Yeah,
Fridge,
your fridge, that
washing
sort of stuff.
machines.
Lots of people improved their homes.
homes, yeah.
But everyone tried to do that all at once, and that caused a fair bit of inflation across some of those particular stuff as people bid up the price to actually get that sofa or that fridge.
Yeah.
We've now started to see inflation spread over into more services type industries where as sort of the New Zealand economy's normalised, we've come out of lockdown, we're now seeing price increases at stuff like restaurants and cafes, we're seeing price increases across other things which you don't tangibly buy, stuff like airfares, for example. People are going out and travelling, we're seeing inflation across a broader portion of the New Zealand economy. But as demand slows, we hope that that will create more of a balance across supply and demand so that prices don't keep going up at the rates they are.
And we're seeing that, like in this graph, you can see, I think the pink, the Mawhiro line there is nominal spending and it's pretty flat. But once you account for the fact that things have gotten more expensive, so once you convert it, deflate it, make it real, then real spending on durable goods, which I think is the blue line there, has actually fallen. So again, consistent with this message that, the Monetary Policy Committee, we're confident that we're on track to cool the economy as we need to control inflation. And this is, just one sort of example of that cooling in the economy.
Yeah, I think that's a great example of how in monetary policy what we're really looking at is that excess demand.
Yeah.
And like you were mentioning, Paul, with the structural things that change maximum sustainable employment, what we really can look at and what we really can influence is that excess demand
That's
for
right.
labour around that maximum sustainable employment, and very similarly for then demand in the economy. There's very little we can do with our policies to hit all those structural, we call supply side issues. But what we can do is monitor these demand side, these excess demand side issues,
right.
which lead to inflation, which lead to the fact, that's why we look at consumer prices as well. At the end of the day, we are concerned with, although we're concerned with inflation and there's many different parts we worry about in terms of how it impacts the economy, including businesses and investment and all these things, we are still concerned with what people can buy, that's why the consumer price basket is trying to be representative of what people can afford, because we are concerned about that real purchasing power of New Zealanders. And that all kind of ties into this excess demand story and holding inflation to account, bringing inflation back, I suppose.
So monetary policy, it's a demand side instrument, as you'll all know.
Yeah.
It changes in interest rates or other monetary policy tools that we might deploy affects aggregate demand in the economy, whereas what drives the supply side of the economy is a whole different set of stuff, and we've got a productivity commission that works in that space. But we sort of control the business cycle around that long run potential trajectory of the economy. And the other thing I'll just sort of riff off from Marie, she talked about people, and I think it's a real hallmark of the economics team here at the Central Bank. These are not just graphs and equations and tables of coefficients. We fully get that there's people underneath all of those and that our decisions affect people. And again, that sort of takes me back, the hallmarks of a good economist. It's not just sort of intellectual gymnastics. It's about improving, well-being of people.
And so we also talked a bit about what you see in this chart as well. We're now starting to see labour shortages starting to ease as the economy starts to cool. Labour is in pink on this chart. And we're seeing a lack of orders, for want of a better term, as you can see in the blue line, starting to re-emerge in the economy. That's consistent with us opening up capacity pressure in the economy.
That's
So over time, that will slow inflation as supply and demand becomes more in balance here.
So I like this chart because it shows us the labour market cooling. So labour, has been the kind of constraint on firms is becoming less important. There was a time there not so long ago where businesses weren't able to open as long as they wanted to because they couldn't find people, workers to do their thing. So clearly a labour market and an economy that's out of balance So that's less of an issue now than it was been, although our labour market is still very tight. And also the fact that that blue line, orders as a constraint is going back up, again is consistent with sucking a bit of heat, a bit of pressure out of our economy.
I think what I also enjoy about these graphs, or to highlight and riff on what you riffed on my riff,
Riff it back.
yeah, I'm just going to riff back.
Yeah. Is that
Sort of riff battle. Yeah.
that's riffing cubed? Is it?
I think what I enjoy about these graphs are trying to understand the economy. Like Paul says, it's real people, it's real business, it's real life. It's you walking down the street and noticing that your favourite restaurant is currently
Absolutely.
either closed because you're not allowed to purchase there at the moment, or it's open but they've only got one staff member, and so things are really slow in getting your food out. It's about everyday life. The economics is about everyday
right.
life and everyday people, and how we understand what's going on and how we manage things like interest rates to make
absolutely.
that easier, because that's the idea, right? Inflation is like this gritty thing in the sand in the cogs, right? And you're just trying to pull it out so that people can live normal lives and businesses can go on like normal everyday things. And so that's why I enjoy these. Just understanding these graphs, they're not just lines on a piece of paper.
No.
It's real life, it's real people,
Good
it's real
riffing.
decisions.
Good riffing.
I think
And
you
I
won
love
that
it.
riff battle.
Yeah, I did. Did I say I love being a central bank? Okay.
The other thing I like about this graph, the other thing you can tell from it, what's that bottom line? My glasses
Materials?
are wearing out, but materials. You can see that became more of a constraint over COVID. So that was when supply chains globally and domestically were all gummed up. People couldn't get hold of jib, for example, to build houses. So again, you can see that period, we're getting back to a more normal period. Again, we're kind of moving on from those COVID years, slowly but surely. Global supply chains are healing up, and same with domestic ones. So another, positive sort of, weight on the positive side of the ledger.
We've also started to see, as we saw that labour line come down, part of that has been caused by an increase in labour supply. Some of that has come from migration across the border. As you can see in the pink line there, we've had a lot of inward migration recently. Migration affects both sides of the ledger though. It causes extra demand because when a new migrant comes to New Zealand, they need to go out and buy a fridge and might want to buy a house, need a car to get to work, need some clothes for the kids and school uniforms and that sort of stuff. And so that means that there's some extra demand there. There's also some extra supply because those people come and work. And if you have a lot of labour shortages and people looking for staff, they're able to help fill that. And the question that we're really interested in at the central bank is, what is the relative balance of those two things? Is there more of a demand effect or is there more of a supply effect? And there's lots of different empirical research around that. And research that we've done here at Te Pūtea Mātua over the last decade or so showed that it both differs for the kind of migrant that you have, but in general, migration's a touch more inflationary because the demand effect is slightly higher over the horizon we care about, but over the long term, it improves the productive capacity of the economy, and that supply effect dominates over, say, 10 years.
Yeah. So a positive supply shock over the long run. So, the interesting thing of this graph, you can see obviously we're having a huge spike in migration at the moment, and there's a bit of uncertainty about how accurate the numbers are, but we sort of take them at face value. But there has been a reset in terms of migration policy. So the types of migrants that we're attracting now, may be different to what we've seen in the past. So all the previous work that Andre's talking about, it'll still be relevant to varying degrees. Also, the labour market is incredibly tight, so a lot of our business contacts are saying that migration is sort of alleviating pinch points in the labour market, which is good for inflation. But there's a lot we don't know. So, just to give an idea of a typical day job of someone in the economics team, like someone will be pouring through this data and figuring out how a migrant now is different from a migrant in the past and what the likely impact of they're going to have on the demand side of the economy and in the short run and the supply side in the longer run. So, just everything is changing all the time. I kind of think of it as a dance and people are always just trying to what's the most signal that we can extract from this data to tell us about what's actually going on out there.
Marie's done some good work on job-to-job transitions as well.
Oh, yeah.
around-
Go check out the
around-
analytical note.
Yep, she's helped
Yeah.
publish in this space and pushed us forward.
And I know there's someone upstairs right now actually looking at those numbers,
Yeah.
trying to understand
Yeah.
based on the literature as well and what
Yeah.
we know about going
Yeah.
forward. It's not easy because who can really predict the future perfectly
Oh.
well? But we try really hard to understand.
It's a social
We
science.
work really hard at understanding.
It is about predicting the future, which is tough. I don't even know what
Yeah.
I'm going to be doing next week, never mind everybody else
After
in the
this
economy.
meeting, yeah.
And there's lots of stuff we just can't predict, right? We
No.
couldn't predict the war in Ukraine, we couldn't
No.
predict COVID.
Of course
No.
not.
There's a whole load of stuff that just happens and we have to deal with
That's
in
right.
real time
That's
in the
right.
economy. That's
Yeah.
part of the fun of working here.
That's right.
And
And
some
I-
of that is economic theory, and some of
Yeah.
that is data, and some of that is just
And not all.
working logic. Yeah.
Yeah, exactly. It's not all just data like this, which is a time series.
Yeah.
Like the work that Marie's done on job-to-job transitions is in the microdata. So we have, under very strict conditions of access, we have data on who works for what businesses, and we can see people moving between businesses, and we can see what happens to their salary, and all that sort of stuff. And it's a total treasure trove for economists. So we have, really skilled empirical people like Marie, going through all that stuff to really, what's the message in here? What are we learning? What can this tell us about our eternal quest to lower inflation?
Couple of last bits on the recovery from COVID. We've now seen the border reopen. In this chart, you can see the period where the border was closed, which is the big gap between 2020 and 2021.
That's shocking, eh?
It
Like,
really is.
watching that go down, that's insane.
confronting, yeah.
right?
No
that's-
tourists.
Yeah. And you can see, of course, that bump in the middle, that must be Aussie's.
That's
travel
Australia's
bubble.
Yeah,
Travel
that's our
bubble.
travel bubble.
bubble, yeah.
And we're now seeing that rebound. You will have seen a lot of more tourists around on the streets recently, and if you've been out over the summer at the beach, it would have been a bit fuller than it might have been previously. And
And
that
here in
affects.
Wellington, we can see all the cruise ships coming in.
Yeah.
A good indicator.
I would always take a photo every time this cruise ship was in the harbour and send it to my team. Sort of, here's the demand. It's back.
Counting cruise ships.
Pretty much.
Absolutely. Absolutely. Get our data wherever we can find it. Yeah.
That's a true story, by the way.
I believe it.
All right.
So what, Andre? We're back to almost 75%
Yeah, about
of pre-COVID,
pretty good,
and it's recovered really quickly. And this is without Chinese tourists,
correct,
because Chinese tourists effectively couldn't leave their country over summer. So they're starting to trickle back. So we expect to see those pink bars to continue to increase. And again, figuring out what does it mean for inflation? What does it mean for the economy?
What does it mean for employment?
What does it mean for employment?
Where are
Yeah.
people going to have to be to service
Yeah, and how do you
the tourists?
Yeah, like rental car companies building up their fleets of
course,
cars
yeah.
and planes being pulled out of the desert, to have a kind of supply, build the capacity for this surge in tourism. And of course, people, moving between sectors of the labour market.
Yep.
Construction is kind of starting to flatten a bit here and there. So people moving from there into hospitality jobs, for example, all of this we're on top of and we're interested in.
Speaking of construction, you can see in this chart here that house prices had a big run up through COVID and have now started to fall away. And that's consistent with construction starting to slow down. A lower house price means that a new developer is able to make less income, and so they'll have less developments, and that frees up resources in the economy because there's less demand for labourers and for plumbers and electricians and all of that sort of stuff. And you can sort of see here that we think that house prices have mostly finished their fall, maybe just a touch more yet to come, but this is something that we monitor closely because it's a good sort of macro indicator for demand across the whole economy, and is also one of the many ways through which monetary policy transmits through the mortgage market.
And also, oh, you go, Marie, you go.
Oh no, I was just going to say, if you are interested in monetary policy in general, asset prices, my goodness,
Yeah.
could you spend an entire lifetime trying to
of
understand
course.
what asset prices
Yeah.
are going to do?
And
And they're so important actually to the transmission of monetary policy as well. But like Andre says, this is, we take our best assumptions or understandings based on whatever data we have, what models we have, what theory we understand, to make these predictions on what's going to happen to the housing market. But housing market share prices, all those
Are
kind
very
of asset
difficult.
prices are very difficult,
predict.
notoriously difficult.
We
actually.
and we've got it wrong before. We got it wrong with the big bubble that you saw appearing in 2021.
Yeah.
We have a bunch of indicators and models, but ultimately it's human behaviour, and you sometimes can't predict human behaviour because it changes so rapidly and can differ.
That's right.
So
I think
yeah.
like lower interest rates were a factor over
course.
that period, but also what you were talking about earlier, people spending more time at home, like lockdown or working from home. So it's kind of like a preference shift. You know, people all of a sudden valued their house more. So the value or the price of houses went up over that period. And the reason why we're interested in that is through a wealth effect.
That's right.
So if people are feeling wealthy because they get a letter from the council saying their house is worth $300,000 more than they paid for it, they go choice and go shopping off the back of that. So that wealth effect is how the kind of what's happening in the housing market translates into the inflation space.
The example I like to give on the wealth effect is if your house has gone up, you might take out a bit more on the mortgage and go buy another car or a boat or something like that, and you sort of see it in durable goods, and that's the sort of really tangible spending you get.
Yeah.
We're also seeing a bit of a slowdown around the world. Every economy around the world pretty much has had some form of inflation coming through. Central banks around the world have raised interest rates. It's not just us, it's the Aussies, it's the Canadians, it's the US. You can see our forecast for GDP growth in black on this chart, but you can see that the rest of the world's also likely to go through a bit of a slowdown as everyone works to contain inflation. And we won't be immune from that offshore. We're fundamentally an exporting nation. We're a nation that trades with the world. And as part of that, if there's less demand for the products we export, stuff like dairy prices or meat prices, that'll affect the prices that we're able to get for our goods and will help slow the economy here as well, from the economy offshore slowing as well.
We're not an island.
Wow,
We are
we're
an
multiple islands. We're multiple islands, Paul.
We're not an economic island.
Yeah. And in this chart here, you can see this is what we've done to try and get inflation under control. You can see that the official cash rate's now at 5.5%, up from 0.25% at the bottom of the crisis. So over 5% increase in the official cash rate to date. And that's to slow demand in the economy. But we know that monetary policy operates with a lag.
Yep.
We're still seeing some of those effects starting to come through the economy. And so, as you can see in this chart, the Monetary Policy Committee's forecast is that the official cash rate remains at 5.5% for a while yet.
Yeah, and it's really important to say, that's not forward guidance. We're not saying that's it, we're done. All we're saying is that we feel that we've got interest rates to a point where, they're doing what they need to do. They are restraining demand and therefore, disinflationary. And effectively what we're saying with that flat line at 5.5% is we'll see how the data unfolds from here. What's the economy going to do over coming weeks, quarters and years? That'll determine where we go next with the official cash rate. I guess with this, that flat line prediction, we're kind of roughly saying, the next move could be down, or up, or sideways.
Maybe all three.
Our central says sideways. But it could be.
That's kind of what we were talking about earlier. These
Yeah.
are projections. It's not a crystal ball. We're not saying we can tell what the future's going to be. It's like saying, from the starting point where we are today, or 2 weeks ago in this case, and if things kind of unfold broadly as we expect, then this broadly is the a likely path for interest rates. But if unexpected things happen or economic relationships change, then that's that dance I was talking about. We'll be back. We get to play with this every 6 weeks, and we'll do what's required to achieve our mandate.
Nice. All right. Got some questions coming through about
Great.
this little presentation. So actually just riffing off Paul's last comment, how come it's every 6 weeks? Why not sooner? Why not later?
It's so 4 times a year we do a full monetary policy statement where we put out a full set of projections.
What's the difference between a monetary policy statement and a monetary policy review,
Yeah.
just quickly?
Yeah, and then in between those MPSs we'll do a review which is like we still do a full set of projections internally, but we don't publish a report on it. We put out a record of the Monetary Policy Committee meetings and a press release. Like in terms of timing, I think it works quite well. It's sort of the data that we get is it's not like I've got more data this week than I had last week. So my view on the economy hasn't evolved that much. There'll be a little bit here and there, and then there'll be big set pieces of data like GDP or what's happening in the labour market or in the inflation space. So it's kind of, it's balancing, how often do we get new information and how often do we feel the need to sort of make a policy change. We can make a policy change anytime we like under sort of urgent situation, but, touch wood, that's not where we're at. So 6 weeks feels about right.
Nice. All right. Is there anything you guys can do to control inflation bar moving the OCR? Kind of what other tools do you have at your disposal?
Yeah. We've got, I'm going to end up answering the question. We can do quantitative easing, so QE. You would have probably heard of our LSAP program where the central bank buys government bonds to sort of lower interest rates further out across the yield curve. That's in our toolkit. There's also a funding for lending program where we can lend money to banks at a particular rate, which influences interest rates. So we sort of had a crash course in alternative monetary policy tools over COVID, where the official cash rate was effectively at its lower bound at 0.25%. It couldn't go negative because the banking system was unable to cope with a negative policy rate. So, these other tools got added into the mix. What was the question? Was it how can we control interest rates or inflation?
Inflation.
Yeah, and then so controlling inflation, we talked earlier about monetary policy being a demand-side tool. And in the context of an economy, our productivity isn't great in this country. So if we had better productivity, then we would be getting more out of the supply side of the economy. And that's not how you would control inflation in a kind of cyclical sense. But if we were a more productive economy, if we had better productivity growth, then inflation overall would tend to be a bit lower than it otherwise would be. But that's not what we do here at the central bank.
The other really big tool that we have as well, because all of those tools that Paul talked about are sort of downside tools. They're stuff that we're trying to stimulate the economy and get it to grow faster once we've run out of headroom on the OCR. But the other really big tool we have is forward guidance. The Monetary Policy Committee, both at the bottom of the cycle and at the top of the cycle and at all times in between, says a lot of things in the record of meeting. They go out and give press conferences, go and talk in the media, write a whole lot of stuff down so that people can form expectations on what's likely to happen in the future. And those expectations are really important because if your parents, say, have a mortgage, that mortgage will be a 1-year mortgage or a 2-year mortgage or a 3-year mortgage, and your bank will set that mortgage rate based on what they expect Paul and the rest of the Monetary Policy Committee will do with the official cash rate. So it's a really important tool to be able to influence mortgage and deposit rates through the economy.
I think that's true. That's a good point, Andre. I think the more people understand economics, economically literate, then I think the better the economy operates. So we put a big effort, into comms, such as this, to you guys, to school kids. But we do likewise, we've got different comms channels for different audiences. But I think it's a really important part of what we do, making sure people understand what we're doing and why.
And I think I'll add to that, and that, most modern advanced economies, for example, would only use the OCR, that alternative monetary policy tools, is really when it's stimulatory, when you can't do anything more with the OCR and your hands are kind of tied.
Yeah.
But that being said, we recognise it's a broad tool. We recognise that there are distributional consequences of using this tool, and we do research into understanding it. So it's not that, sometimes people think that we're cold or we don't care or we don't think about these things, but we absolutely do. It's just that we don't have the tools in our toolkit to address those issues, but we can understand them better so that we can coordinate across macroeconomic policies, across the economy, so that we can deal with some of the distributional effects of having to use the OCR to manage aggregate demand.
And that's
Yeah.
where fiscal policy steps in, right? We have the official cash rate,
Yep.
and it's the role of politicians to decide what the distributional consequences of interest rate rises are likely to be and to mitigate them depending on their personal political views, and it's up to you or your parents as voters to decide the sort of distributional consequences that you'd like.
We've got a bit of a fun one here. Hypothetically, what would happen if you dropped the OCR to 0.0%?
No?
Yeah, right now.
We're not going to do that.
No, hypothetically, what would happen? Would it be fun? What would happen?
It wouldn't be fun.
Fire, burning?
It would not be fun.
It would be bad. It would be.
Yeah, bad.
It would be disruptive.
Yeah, just a
Perfect.
short list of stuff off the top of my head.
Yeah, well,
You'd see house prices go up a whole lot because people get really cheap mortgages. You'd probably see the currency fall a really long way. You'd have a whole load of inflation because of all of that.
Massive.
And you would actually see your standard of living get much worse.
That's right.
Very
because
quickly, isn't
the
it?
income that you or your parents get wouldn't be able to buy as much at the grocery store, and you'd find it really hard to actually be able to live really well. And that's why we are considering inflation.
And like even if your exchange rate, like making the exchange rate dropping would mean that we can't pay for the goods we import, right? So the entire economy would go into massive amounts of debt that we'd have to pay off for generations to come. It's
forget
not,
about your iPhones.
So what I'm hearing is 0.0%.
It's not a good idea. Not a good idea.
That's a fail. Like, don't make that your official entry.
I don't know if we should name names, but there is a country in the world right now
I
that
was gonna-
decided that in the face of high inflation, what they really have to do is
Turkey.
drop. Oh, are we calling them out officially?
Turkey.
Okay, yeah. Turkey decided to drop interest rates.
Inflation peaked at 80-something%.
Yeah, so if there are real life, real world experiences of what happens when you drop interest
Yeah.
rates,
Wow.
and it's not good for the people of the country.
Bad idea.
All right. We recognise that making decisions about monetary policy is far from straightforward. What's the hardest or most difficult decision you've had to make? Are there times where there are no good options?
I'll jump.
Yeah,
you want to
please.
jump
No,
in?
you
Do you want to
go,
give me some
Marie.
time?
No,
to
you
think?
go,
Marie,
Marie.
please.
I was actually thinking about this, and I was like, we're all human. We all prefer supporting the economy than pulling it back, right? Like we have this natural emotional response to what we have
course.
to do because,
That's your economy too.
yeah, it's our economy too. It's our families too.
Yeah.
It's us. Like we are the economy, so we feel those things too. I don't know if there are. I think there are the generally right decisions to make, but I don't always think they're easy, and I don't. So it depends how you define good, I
Yeah.
suppose.
Yeah.
So I think there are the right decisions to
Yeah.
make. I think those decisions, especially when it comes to the fact that we are trying to have this medium-term outlook, there might be some short-term pain, but this is about
That's it.
protecting the purchasing power of people over the medium to long term, and that requires uncomfortable, right decisions.
Yeah,
Yeah.
nice. I agree with all of that. It's been hard work lifting, that pink line. I don't know if it's still on your screen, but increasing the OCR by by 525 basis points in the space of 18 months, a little longer. The emotional labour of that. It definitely weighs on me as a member of MPC. But as Marie was saying, we've got a lot of science. We know that it's what we need to do, and there is short-term pain for some people in the economy, and people with savings love it. So
Yeah,
it's
that's
not it's not just clear cut.
That's true.
But we just know that inflation is
everyone.
nobody's friend,
Yeah.
to quote the governor. And the best thing that we can do is to slow things down, even though that does hurt at the margin of households, because the short-term pain will be far less than if we were just to let inflation rip. So yeah, it's a matter of sticking by what you know and being really, resolute was the word that we used when we were putting up the OCR quite quickly. We were focused on achieving our mandate.
And that's in part because households are hurting at the moment with high inflation.
Yeah.
And
That's
so
right.
Choice
it's-
between evils.
Yeah, it is that choice between evils. It's the two parts of our remit and trying to balance those
That's
two.
right. That's right.
I was sort of thinking on sort of what the hard stuff we've had to do,
Yeah.
putting up the cash rate. One thing that I've found hard in my career was coming to the committee with projections with much higher unemployment and sort of thinking about how many people, sort of tens of thousands of people, being unemployed in New Zealand. And that's a really hard thing to sort of internalise and to talk about, but it is the scale of the trade-off that monetary policy sometimes has to make.
And I think that's jumping back. That's also why every 6 weeks might be just as much as we can do, because hopefully what you've heard from this conversation is that an interest rate decision, there's a lot of work that goes into that.
Yeah.
It's a very long process. It's very involved. We try to talk to a wide range of people all across the bank, across different departments, because, you know, we have to worry about or get input from financial stability as well as part of our secondary objectives. So there's a lot of thought. There's a lot of work. It's a very involved, it's interesting, it's fun, it's exciting, it's hard. And it does take 6 weeks to pull that together at a time.
And we talk to people outside of the bank as well. Like we have a
Exactly,
big
yeah.
program around visiting businesses across the country. And we're just getting better and better at sort of getting out of Wellington and just, you know, really, as well as kind of seeing it through the data, you know, understanding what's really going on the ground around the country.
Great. We'll move into some more kind of like career-based questions. We kind of dig into what you guys do here and stuff like that. Let's start kind of high level. What's the most fun thing you've got to do?
Today,
Today.
That's the right
If you don't
answer
say
every
this
day.
webinar, Paul, I'll be very upset. So just pick
this
carefully.
webinar, George.
Exactly the answer we're looking for. Thank
Like
you.
I love the comms. I really love it. Like
Yeah.
I kind of feel nervous and stuff like that, as you know, fight or flight kind of thing. But I just think it's so important, and I get, you know, I really enjoy hearing where people are at and stuff like that. So I'd say comms is one of the most fun things I get to do here at the bank.
It's
Right.
changed. It's changed for me over the years. So when I was younger, especially working at the central bank, it was kind of great to travel to all the different courses or conferences and just going to see the world and getting to
definitely.
get out there, right? And the world's a huge, amazing place. And so getting to learn about more economic topics from experts was a really big draw card for me. I really enjoyed that. And now, like, I'm still not great on the comms thing, so I'm not going to choose comms. But I enjoy the variety of the interesting things you get to learn, the interesting people you get to talk to. I think we're a really fun team, so sometimes there's singing as well daily that gets led by me. So there's a lot of, and it's not all just fun, it's just, sometimes it's fun because it's interesting, like even getting to sit in monetary policy meetings and getting to hear about the things that people are concerned about and these really in-depth discussions about the economy and where we're going and strategy around policies and that kind of thing. It's just, I find so much of it fun, to be honest with you, and the type of fun differs day to day.
Really-
But I really like it.
Yeah, like it's really, you know, we feel privileged to be in the position
100%.
where we're making, you know, these calls and other people are supporting these calls being made by the Monetary Policy Committee. Like I feel this job like no other job that I've had in the past. Like it's super important to me that we get it right.
Yeah.
I kind of, you know, bike to school along the waterfront going, don't mess it up, don't mess it up. You know, and that responsibility, it's not exactly fun, but it's definitely a career highlight that I'll look back on with fondness in years to come.
Great.
Andre, what's your fun thing?
Yeah, I really enjoy being able to have some really good, interesting discussions around this building.
Yeah.
There are lots of smart people that have seen lots of cool stuff, and I really like that in this workplace everyone's able to make time for you and to have a really good, challenging discussion and to be able to sort of have a bit of back and forth around it. That migration one is a really good example where there is a legitimate difference of opinion in there, and different people in this building have different views on the relative way up of that supply and demand. And I really enjoy being able to be part of those discussions where I'm able to sort of think really critically about it.
I should say we're quite a diverse team, so it's you know, diverse teams make better decisions. So there is a real sense of a variety of perspectives coming at any one issue, and I think we're getting really good at just having rigorous conversations across that difference. You know, we're playing the ball, not the person. We kind of come out of it, you know, with even more respect for each other, because, you know, we can kind of hold that sort of space as a team. I really enjoy that too.
We're all working to the same goal at the end of the day. Like,
We want inflation to be back in the band.
Oh, very strong common purpose.
All right, another question from the audience. I want to go into economics, but I'm worried I'll be the only woman on my team. Marie, this might be a question for you. I think you'll be able to talk this. But Paul, you've been here for a life. Yeah.
I mean, Paul will have seen it as well. I started in this profession 15 years ago. It looked very different 15 years ago. It is amazing how it is now. I think I think my team might even be female dominant at this point. I'm not entirely sure. But there are a lot of women here. There's a lot of women in leadership roles. You are treated as an equal, as an economist, first and foremost, or maybe not, well, depending where you are. You might not be an economist working for the central bank, but you know what I mean. You're treated as a professional first and foremost, and I find it actually really inspiring to watch the profession grow like this out of its kind of the stereotypes that existed just 10 years ago. And it really has been an incredible change in a short amount of time. And so no, you will not be the only woman in the bank.
Like I think, like you know, I was talking earlier. We've got a diverse team here, and it's gender. I can't remember what the ratio is, but it's pretty close to 50-50 in the economics department, which is great. Like I just love that. It's fantastic because diverse teams make better decisions. But I think we are a bit of an outlier here at Te Pūtea Mātua. I go to sort of conferences, and there is a lot of you know, white. Well, men like me, essentially. I can be in a room thinking, oh, I'm quite young. Compared to all these guys.
Young at heart.
And, you know, there's wisdom in that crew, absolutely. But then I come back to the bank and we have a meeting, you know, on something, and it's just young people kicking it around and bouncing off each other, you know, and I just think, oh, thank goodness I'm home. You know, I really love it. So please, you know, become an economist if you're female. Don't let gender or ethnicity or sexual orientation or anything put you off. You know, like, yeah, the profession, well, as far as I can represent the profession, welcomes that with open arms, please. You know, we need diverse insights.
And it's also really important in that the economy affects everyone.
Absolutely.
If you live in New Zealand, the
That's
economy
right.
affects you whether you like it or not.
That's right.
You don't have a choice. It
No.
happens to you, you live in it, you'll one day need to look for a job. And so we're really conscious of that here.
Yeah. So the more representative we are, the better we'll be at our jobs.
This one might be a question for you, Andre. Do you think it's better to go into a grad/internship program or just go straight into the workforce? Because
Honestly,
I know we offer one here. Both, actually, a grad and an intern program.
honestly, I think it depends on, I guess, what you want out of your career, right? In that there's benefits to both. A sort of structured graduate internship program is about making you sort of get across a whole bunch of different things. So at the Reserve Bank, I've been in multiple teams and saw lots of different stuff. But some people, when they leave university or you in high school, might have a particular thing that you want to go do, and there might be a particular career pathway you'd like to follow. And if that's the case, absolutely just getting into a job that's on that particular career pathway that's a bit narrower might be more appropriate for you. So it really depends on exactly what you want out of your career.
Yeah. And that takes time. That doesn't magically come to you. It takes a lot of time, it takes a lot of talking, it takes a lot of thinking and reading and watching documentaries and discovering who you are and what makes you tick and where your passions lie.
I turned up at my first day of university and didn't know what I was going to study. I knew that I decided I was going to university because my parents were like, this is something that's sort of expected. And so I turned up, and up until that point, I'd mainly done science through high school. And I sort of looked at all the different programs, and within that first week was sort of like, this finance thing looks sort of interesting. I'll go along to a few lectures and found that I really enjoyed it. And I've subsequently done the same with economics working here, and you sort of evolve over your life. Don't
Exactly.
feel like you need to have it all planned out now,
Oh, you
because
don't.
even if you think you do, you won't.
You don't.
I totally agree with that, Andre. All right, a bit of an interesting economics question, just to go back to economics, but I'm quite interested in this one that's been submitted. Can you explain in simple terms why more money can't be printed to solve things like the cost of living pressures?
Yes, I can.
2 hands up. Let's share the load.
Go
I can
on,
give it a go. If you're thinking about what you need to live, it's not money. It's actual physical goods,
can't
right?
eat money.
You can't eat money. You can't drive a car with money. You can't use money itself to get to work. What you have to do is you have to trade money for all of those things,
Yeah.
right? And so if everyone across the whole economy has a lot more money, that doesn't actually create more eggs, as the example I used earlier, or more
Yep.
cars, or we can't do anything at the central bank
Can't feed it to chickens.
Yeah, we can't make more petrol when petrol prices go up to push it down. We can only make more money. And more money, if it chases too few goods, leads to inflation. And that makes the cost of living crisis worse, not better.
Yeah.
Anything to
Pretty
add?
good. No, I
A plus
Great.
answer.
Yeah.
Copy and paste that one.
yeah.
Actually, on that, do you guys use ChatGPT? Do we use it here at the bank?
I don't think we are at the moment. Like, my view on that is I just see it as a tool, and I think if it can, we're knowledge workers here, and if it can help us do our jobs better, I'm all for it. And I don't, it's not going to end up running the economy, but if it helps you write a briefing note on something, and I think what it spits out, is kind of generic and a bit boring, but if it can provide somebody with a good start for something like that, then so be it.
I have that writer's block where I just start writing and then rewrite it and then rewrite it and then rewrite it, and I really struggle with that. So I find the AI really helps. It also can help you summarize papers. There's more than just ChatGPT in the AI world, and it's actually really fun and really interesting, and also very scary. And there are very smart people working on the scary aspects of AI, and I trust them to find those solutions for us.
Get it right.
Yeah. What I will warn everyone, though, is that ChatGPT 100% can get things wrong. It has definitely given me wrong answers. It's given my manager wrong answers. It's given my partner wrong answers. We're just like, no, that's not right. And if you tell ChatGPT that they're wrong, by the way, they apologise to you. The ChatGPT
that's good.
apologises. I'm so sorry, blah, blah, blah. I got that wrong.
That hallucinates.
So it's like the same as Wikipedia, right?
Yeah.
Like you can go to it and have a look, but don't trust it as a source of
No,
truth.
definitely not.
It's really good at writing poems, though. Yeah.
Oh,
yes. In the style of your favorite rapper. That works.
Oh,
as well.
even better.
Remember
Or
when-
political leader. Yeah.
When it first came out, we gave it one of the housing speech you did, Paul,
Oh, yeah.
and asked it to do that in the form of a rap, just to see
yeah.
what it would do.
Was
It did an
Eminem,
okay
wasn't
job
it?
of that, yeah.
For the Winston Churchill version
Yeah.
Oh,
of the housing speech. Or was that the next speech?
On
Anyway, I
inflation,
can't
in fighting
remember.
inflation on
Yeah.
the beaches. Yeah. That was
But just more generally, we're all, we're right at the forefront of using new technologies. So, we're into using AI. We're, at the moment, just for example, we're creating a sandbox within the economics team where we can just throw a heap of data in it and just let an AI rip, really, just to see what happens. And there's all sorts of, kind of empirical techniques in economics, like, machine learning and that text analysis.
Which is all AI.
Yeah, which is all AI driven. So we're absolutely keen on all that sort of stuff.
As a tool, but not as a source
tool,
of knowledge.
as a tool. Don't use it. Don't cheat in your exams. Don't use it.
We'll find out. Final question. What's your last piece of advice for the people watching at home? For young budding economists?
Well, I'll start. Like,
about it.
go hard, be passionate, bring your full self to the task at hand. There's issues. We've got issues in this world. If it floats your boat to be part of the solution to those issues, just go as hard as you can and do as much good as you can, and don't be put off by setbacks. Just get back up on the horse.
I think, that would be the advice I'd give myself, actually. We all, we're probably here, we were part of the work hard group in high school. So play hard too, and in playing hard, find out who you are, what you like, What interests you? What motivates you? What moves you? Who do you want to be in the world? And if that is a policymaker in monetary economics or in monetary policy, we'd be very happy to have you here. Yeah.
If you're really good.
If you've worked hard as well, Paul, that's the point.
Yes.
I'm going to give you some advice that actually Paul gave me a while ago, which is, yeah, you're young, go have some fun. Enjoy your life. You won't have it all worked out yet. But
You don't have to.
And you don't have to,
Because
exactly.
no decision's actually permanent, right?
Exactly,
You can change
exactly.
your mind at any time.
And if you find that every day you're doing stuff you like doing, you'll end up in quite a good space. And that may be in economics, it may not be, but do things you enjoy as a rule. Sometimes you have to do stuff you don't like, and that's just part of being an adult. But as a rule, if you're spending sort of 60 or 70% of your day doing stuff you enjoy,
That challenges yourself
That
as well, right?
challenges you.
Like, challenge yourself.
that makes you feel fulfilled,
Yeah.
you'll have a great time.
100%.
Nice.
Great.
Sage advice.
Just cautious of the time. Andre, shall I pass over to you and give you the honours of reading out this year's challenge question?
Cheers, thank you. So this year we are in line with the chart of the official cash rate you see there, asking you, when do you think the official cash rate will move from 5.5%? In which direction do you think it will move and why? And there's a number of pointers we're giving you in order to be able to better answer this question, and we will be marking your challenge entry based on them, including on the presentation and your video style and that sort of stuff. That's all also really important to us. The criteria are, first we'll be looking for your central expectation or forecast for inflation and employment, and why this forecast justifies your choice of OCR move. As you will have heard from the panel today, we have different views even internally on what that forecast should be. You shouldn't feel like you need to stick to any sort of externally produced forecast. Secondly, how you balance competing global and domestic economic factors to form your central forecast. There's a lot of stuff going on, as you saw on the presentation. You should think about those. You should tell us how you've been thinking about those. And finally, how global and domestic risks could change your outlook for the OCR if those risks materialise. And that's the sort of stuff Paul was talking about earlier, where he was sort of saying, stuff happens. We get new stuff all the time, and we'll change our minds if new things happens that we need to deal with. And we want you to have a go at thinking about some of those risks.
And it'll be the quality of your economic argument that gets you over the line.
Absolutely. And there isn't a right answer to that question.
No.
There simply isn't. And I really enjoyed, I did the shortlisting for the ones that we had last year, and I really enjoyed the really diverse range of opinions and views we had in the question that we got last year, and some really good economic thought. And for the winners, we'd love to see you here at the Reserve Bank. The winning team will be able to come here, sit in a press conference, meet the governor. We'd love to see you here. So good luck in the challenge.
Great. I can already feel the good ideas coming off the camera now. So before we go, I would just like to talk about the conditions. So in groups of 3 to 5, you guys are going to answer that question in about a 5 to 7 minute video. Submissions close on 28 June 2023. And our prize packet this year, as Andre said, we'll fly you up or down wherever you are in the country to Wellington. You'll sit front row in the press conference. You'll have lunch with the governor, probably with our panel too here if you're lucky. You'll get to meet lots of cool people and kind of see behind the scenes. This year, we're also really thrilled to announce that we'll be offering an internship interview to our internship program. All the stipulations can be found on our website, but this will be a really good opportunity for you guys that could potentially even kickstart your career before you even leave uni. So I really encourage you to go look on our website for all the terms and conditions and give the challenge a go. Now, myself personally... Oh, sorry, Andre.
When do entries need to be in, George?
28 June 2023, 5 o'clock, but if you're a little bit late, I'll forgive you. Now, just like to extend my personal, massive thank you for you guys coming in today and talking with us. We've really appreciated it. I'm sure echo everyone at home. It's been great to hear everything. And it's kind of given us a peek behind the curtain of central banking, which is quite cool.
Pleasure, George.
It was great.
Cheers.
No, thank you guys. And thank you to everyone watching at home. Thanks for all your questions. We didn't manage to answer all of them, but we'll chuck them up on the website on that Monetary Policy Challenge page. If you do have any other questions, send us an email. More than happy to have a chat. Other than that, I think that's us, guys.
Good luck.
Lovely.
Ka kite.
Good luck,
Ka kite.
everyone.